on March. Okay, so we're going to cover the key levels, the technical setups, and what we can expect of the markets in the next month, or at least in the next week. All right, so this is what we're going to cover for today. Right, okay. So let's have a look at the first thing. So what actually happened in February, and that could actually impact the markets. So this is the first thing we'll look at. And the first thing, of course, I would say that it would be the US job and inflation data that show mix. Okay, the first thing is in January, the US unemployment rate is actually ticked down to 4.3 from the 4.4%. And more importantly, the non-farm payroll added 130K jobs, shattering the consensus of 48K. So, and also this is one of the highest hiring pace since late 2024. So it's considered a very good data for the job markets in the US. So it actually reversing the market's expectations that in the past few months, which is markets actually showing very bad things, right? So simply put, the labor markets in the US is showing the resilience and not cooling. So this is what calmed the market nerve, right? But here is the traps, which is over the inflation part, right? The CPI for January is actually slightly down to 2.4, but the core CPI remains sticky at 2.5. So this is the first thing. And second thing, which is more even concerning, is the core PCE price index we seen on last week. Okay, this is considered the Fed preferred gauge for the inflations, right? So it actually rose to 3.0% year on year, beating the consensus of 2.9% and staying well above the Fed's 2% targets. So what does it mean? When you have a good labor data, okay, good job markets, okay, and combined with the elevated inflations, this tells us that the Fed most likely is going to stay higher for longer. Means that the Fed is not going to cut as soon as the market hope for. Okay, so this would lead us to the second point, okay, which is the Fed's outlook, right? So right now we are seeing the market is actually shifting to a higher for longer mindset. Means that the rate is not going to be coming down anytime soon, right? So theoretically, this would actually strengthen the US dollar and pressure the equity markets, right? Because the borrowing costs would remain restrictive. So for the first part, of course, the US dollar, so we are seeing a strong rebound from the low in February, all right? So we are seeing the dollar is actually, let's see, the dollar index is actually rebounded from, let me see, where's my dollar index? Right, the dollar index actually rebound from the low in late January or early February, right? From 96 point to 97.8 something, right? So this is the range that we've seen in the last month, which after the labor markets and the inflation data show a very promising, not promising, showing very good data, right? So this supports, boosted the dollar rebound, right? So this is what we've seen in dollar. Right, so of course, initially the market was actually betting on the rate cuts as early as June. Means that basically the market is not hoping for any cuts until June. Okay, so however, with the latest data shows, okay, those expectations actually dropped significantly, and some traders are start to pushing back their first cut back to July or beyond. Okay, means that for now, June might not have any cuts from the Fed. So, of course, for the no cut expectations, it bolsters the dollar. So we see a dollar rebound, right? But for the stock market, theoretically, is bad for the stock markets. But of course, because the market's basically really pricing the no cuts, so the impact for the stock markets may be limited, okay, because they already price it in. But this the powerful fundamental backdrop for the long terms can be different, right? Because let's look at it this way, okay? Since the stock market already faced that, already accept the short-term reality that there is no rate cuts, means that now the market could be more vulnerable to any sentiment shift. It means that in the previously, okay, previously when the market expect the Fed is going to cut, okay, so if anything bad happens, the market's not going to get panic because they believe that the Fed is going to cut, all right. But right now, the Fed is not going to cut until at least June or July. Okay, means that in between this time from March to June, okay, there's no cuts, and the interest are going to be very high. Okay, so if anything come between this period of time, right, or I mean like anything like a shock, a market shocks, or any tariff shock, or anything else that which is not good for the stock markets, and this could create a trouble for the stock markets in the US or even the global markets. All right, so this is something that we would need to be careful on for in next month. All right, so this is something that we're going to look at. Right, so if you look at the CME fluctuates, now we are seeing for the June cards, it's actually dropped to, let me put on right over here. Right, so this is the June's meetings, all right, June meetings. So the current rate is 3.5 to 3.75. Right now, the market are seeing there is 47.7% of no cuts in June, right, in June. Right, so these previously, I mean like a month ago, is only around 39.39%, correct? So basically, market was expecting a 50, almost 50% of cuts in June, right? But right now we are seeing almost the odds is getting lower, right? Means that you see there's 44.3% of cuts and 47.7% of no cuts. Means that the market is now having a lower expectations on any cuts in June, right? So in June, so this would be something that's considered bad. It's not bad things, but it's not really promising for the markets, right? So this is something that we might want to be cautious on, okay? Especially if any in the futures in the near terms that could pose some risk factor to the stock markets, then this would be considered a added catalyst for the pullbacks in stock markets, right? So this is something that we need to look at, right? So this is the second point that we have for the February. And for the third ones would be the tariff escalations. So if you are looking at market this week, basically we can see that there is a limit of escalations in the tariff or the trade war. Okay, we still haven't like escalated for a lot, but there's something that we want to be cautious on, right? So on February 20, the US Supreme Court actually struck down the initial tariff that Trump put on earlier, right? So means that for the tariff that Trump applied in the past, the Supreme Court actually considered it as illegal, all right? But instead of backing down, Trump's actually pivoted immediately. So he actually invoked the sections 122 of the Trade Act of 1974, all right? I'm actually not sure what this law is, but it's actually a powerful and temporary weapons that allowed Trump under this new authority to apply a 10% tariff on this law, okay? So now he also threatened to hike this to 15%, which is under the legal maximum, if the trading partners don't offer any concessions. So it means that if let's say if the European Union and China is not backing down, and I believe they are not gonna back down, okay, because since we already have a deal, and then suddenly you're gonna invoke a new tariff on my imports, on my export, okay, so I'm not gonna back down, so I might gonna come up with a reiterations, right? So this would be some things that we want to look for, okay, in the next week or even months, okay. Excuse me. So by law, these tariffs only last for 150 days unless the Congress extend them. So I believe the 150 days is more than enough to create any massive policy cliff until July. It means that the markets may be on nerve, okay, in reasons, okay, if we are seeing the tariff escalations escalate further, right? So these would be some things that could cause uncertainty to the stock markets, okay, especially the US stock markets. So later on, we're going to cover on the technical outlooks that we can conclude that basically the US stock markets, the US indices is having the risk of a technical pullbacks or even a short-term bearish markets in the future. Okay, so this is why we're gonna be need to be cautious on March. All right, and finally, it would be the U.S. Iran talk in Geneva. Okay, so because we are still lack of the key detail on the recent talk, so there's still uncertainty over there, and right now, according to the latest news, we are seeing that according to the latest news, they reported that the trade talks is going well, okay, but we are still lack of any updates. So they are gonna, both the parties has already agreed to continue on the next round of trade on next round of talk, right? So right now, this is why the focus will be for on the oil markets. All right, the first thing is that for the last month, okay, we are seeing the US oil, the UK oil going on a uptrend, okay, on a rally, and this is exactly because of the risk premium on the war risk premium on the US Iran tensions. All right, so this is the reason that why boosted the oil price boosted. Excuse me. Sorry, I'm having having a flu recently, so it's a bit difficult for me to talk. so so right now, the focus will be on the US Iran talk, which is because this could impact on the oil markets in the coming weeks or months, right? So this is something that we want to be cautious on as well. Okay, so this is actually the four major macro events of February, right? The first thing is the what we call the strong job and the sticky inflations, and then pushing the Fed to hold for higher for longer. It means that no cuts in near terms. And then we are having the tariff escalation risk. Okay, and then the last one, of course, is the geopolitical uncertainty over the U.S.-Iran tensions, which it could impact on the oil markets. All right. So these are the four things that we see in the last month, right? So how are they gonna impact us as we step into the March, right? So these are the four things that could bring over to the March market. The March markets means that the March market are gonna impact or further escalated by these four events, right? So these are some things that we won't be focused on. All right. So now let's talk about the madness parts. All right. So is March really a turning point, or is this a myth? Okay, so if you look at the S&P 500 over the last few years, okay, the data is clear. Okay, basically, the March has a habit of being the months where the trends, the current trends actually die, or the new trend is born, right? So for example, in March 2020, okay, this is when the absolute bottom of the COVID-19 crash happens, and then after that, the March we are seeing the one of the most explosive rally in the history on March after the COVID crash, right? So this is the first one, and of course over the March 2022, okay, we're seeing the market bottom out on March 14 after the 30% drop, and then lead to a massive relief rally after that, right? And then on March 2025, we are seeing a major reversal signal in the US, in the S&P in the months that set the tone for the rest of the Q2. Okay, where that means that the stock market actually shows the bullish reversal signal in March 2025. Right, so these are the few things that actually came out on March. Right, so we can have a look at the charts if you do, because we don't have full charts over here. So maybe we'll just go through a few. So like for example, over here, yes, we can see that is on yeah, this is over the March, okay, when the stock market go into a strong bearish market, okay, dropping like almost 20%, 90%. then see a sharp rebound. It's happened after the on the March or after the March, okay, or the early April. Right, so this is the first one, and we're also seeing like in 2022. Okay, over here, there's no full chart over here. Yeah, but yeah, I think we can put on the chart later. Yeah, so basically, the March always show a turning point, right? So for now, okay, maybe we could expect there's some patterns could be formed, okay, that in fact would support this thing to happen. So we're gonna cover on later. All right. So why we are calling this madness? So for the March thing to happen, so basically these are a few things that would drive the reversal or some things. Okay, so the first thing, of course, if you can consider this as a myth or a patterns or a history patterns. All right, so historically the March is a month where the market correct the extreme of February. Okay, so take it for example, since the February 2026, it has been heavy on the sideways markets. Okay, we are seeing the stock markets actually on the sideways. Okay, in the February. So this could means that okay, on the March, there might be a risk of a corrections. Okay, or even a new high. Okay, so we don't know yet. So we're gonna look at the chart later. Right, so these are a few things. So basically, when the February price move into extremes, we're gonna see a March breakout. Okay, so for right now, for the US stock markets, we're actually seeing the extreme consolidations over the high side. Okay, so now we could potentially expecting a breakout or even go into a bearish reversal. Right, so this is what we want to expect. We want to be cautious on. So this is the first thing. And second thing is, of course, usually the March is a pivot month for Fed, right? So this is a big one because March is usually a critical meeting because of the summary of economic projection release, which is released on every 3 months. Okay, on the March, on the June, on the September, and on the December. All right. So for now, for the new SEP, okay, which is the summary of economic projections, okay, the SEP, okay, is going to release on March. So basically, the SEP allowed the markets to look more in depth into the Fed's policy decisions, right? So often, when the SEP release something different or some things that could explain more on the Fed's policy, okay, or the policy path, okay, this would actually cause a market volatility, right? So this is the reason why March often sees a special movements or a strong reversal or a trend forms, right? So this is the reason why. And of course, the third reason, okay, is because of the quarter end shift, right? So this is something that we can expect. Usually, those big funds like the hedge fund, the institutional funds, they need to adjust their portfolio for the quarterly reportings, right? So there would be some like profit takings or any positionings, okay, or moving between or the capital flows between asset class. Okay, so this would cause a huge volatility in the markets. All right. So for example, if let's say today I'm a hedge fund manager. Okay, I'm a hedge fund manager. So right now, the market is actually on a strong bear markets. All right. So it's a good time for me to start going to the markets. All right. So after the Q3 closing, okay, I would plan for a new positionings to go for a long, right? So this is a part where these big funds start to come in and the capital flow increase, right? So this is the reason why we always see there's a volatility over the March, right? So basically these are there's few reasons why March always be a very important month for the markets, okay, for the global markets, including the stock markets, including the currency markets, or even the commodity markets as well, right? So this is the reason why, right? So for March, uh, I guess it's for us as a trader. Okay, for us as a trader, this would be lead to two things, right? First thing is the increased liquidity. Okay, and we also see that could be an opportunities. Okay, when we see any strong signal that could form a reversal or any continuations, right? So it means that now we're gonna focus on those major technical level and look for opportunities, right? So this is what we will expect for March, right? So if you're ready, then we're gonna cover on what are the most the best opportunity that we can focus on the March, right? So this is the part where we're gonna cover about the technical. Okay. All right. So I would summarize a few asset class that we could focus on. And this would be the four thing, the big four that we want to focus. Okay, the first thing is of course the US dollar, okay, because it's the most important currency. And the second, US indices, and then the third one with the gold, and of course the fourth one with the oil markets. All right. So the first thing for the dollar, okay, is it a bullish or a bearish breakout? Right, so we're gonna look at the chart. Right, you guys can see my chart, right? Right, so for dollar, in the past month, okay, we are seeing the dollars actually rebounded from the low at 96 point, and seeing the price basically is moving on a short-term short-term uptrends in February, correct? So basically the entire month is a good month for the dollar, okay? But if you look at the what we call sorry, if you look at the recent price movements, okay, or the broad trends, US dollar is actually on a downtrend, right? So this is the part we're going to see. It's a downtrend over the reasons on the day charts, all right? This is downtrends, and if you turn into a 4-hour charts, then only we will see this an uptrend, right? So if you're using the multi-time frame analysis to look at the charts, so basically on the broad trend, it would be an downtrend, right? So if we are seeing a uptrends on the short term, means that this could be a technical rebound for the broad uptrends, right? So means that uh, the broad outlooks for the dollar is still on the bearish, But to have that confirmed, now we need to focus on the near-term time frame analysis, right? We're gonna look at the short-term analysis. So for right now, we could actually see there is a what we call as the ascending triangle from over the top, okay, over here, right? So technically, ascending triangles would represent the potentials of a bullish breakout. It means that this would be a bullish breakout. Okay. However, right now we are seeing this 97.8 to 98 point is actually a major resistance, and we are also seeing a triple tops over here, right? So this means that the market is actually very hesitant to form a breakout over the dollar in near terms, right? So it means that the upside risk is actually not really high. Okay, not really. I mean, it's not really a potential for a breakout or any further upside move in the dollar unless we see a breakout over this level, okay, to confirm the bullish breakout, right? Otherwise, okay, if the price sees a breakdown over these triangle patterns or even these major level key supports, okay, I will plot the key supports over this area, okay, around 97.5. 97.5, okay, then this would signal a bearish reversal for the short terms, and this could lead to a continuation over the downtrends for the broad downtrends, right? So this is where we want to focus on, right? So for right now, because the dollar is actually on a mixed outlook, the first one is because of the hawkish back and there's no cut expectations, which is bolstering the dollar. Okay. On the other hand, the tariff uncertainty, okay, and the dollar confidence are still weak, right? So there is still a risk for a downside breakout. So at this point, if we are still on the uncertainty, okay, it's better for us to look at the technical. So for right now, we are seeing triple tops. Okay, we need to have the triangles pattern breakout to go for a long. Okay, and for the triple tops, if the breakout, the bearish breakout confirm with a close below this level or this area, then it could signal a bearish continuations over the bottom trends, right? So this is the first thing that we want to look at the March, right? So this is for dollar. Okay, and the second thing is for the US indices, all right? Let's take a look at the US indices. Is it the bear markets coming on? And whether it's going to be on a corrective wave. All right, so for S&P 500, so basically we are seeing a multiple tops over the historical high near 7,000 point, I guess 7,000. Yes, there's multiple high. Okay, so basically the mark the recent price actions have reached uptrends, and this is what we call as the ridge patterns, and now we are moving into consolidation patterns, right? So basically, when the price, when an asset is facing pressure over a high side for a period of time and forming a consolidations, okay, or forming a range bound, this would mean two things. The first one would be a breakout, a bullish breakout to confirm the continuation of the uptrends, all right? And the other way around is if let's say there's a breakdown for this range, it would signal a bearish reversal, right? So this is the case for the S&P 500s. So right now we are seeing the top is finding difficulties to break out, okay? Means that in the near term, that would be a risk for a corrective move, okay, or even into a period of bear markets. So this is the first thing that we want to be cautious on. And over the macro outlook, okay, over the macro outlooks, if we are seeing the tariff escalate further, okay, then this would provide a catalyst to bolster the market go into a bear markets, right? So this is something that we want to be cautious. Okay, so this is for the S&P 500, and for the Nasdaq, same things. Okay, the tops over here is facing a double top, and then multiple tops over here this level. Okay, key resistance breakout, and going to a what we call as consolidations, right? This is high side consolidations. So if we look at the past, is there some similar move over here? Okay, you can see that something like this, a new high, and then pullbacks, and then a new high, close to a new high again, and then fail to go up and then break down, right? So right now we are seeing something similar over here, right? So this means that the recent uptrends or the recent bull markets already come to the test. It means it comes to a ceiling. So now it could pose a risk for a technical pullbacks or even a short-term period of a bear market, right? So how do we define whether the price is going to go into a bear market or go into a short-term bearish reversal, right? So for right now, the major resistance will be for on the 25400, right? So this is the major resistance that we could see over here. And for the pivot level, I will put it on the 25,000 point, right? So this is one of the major psychological level and also a major support that we've seen in the past, right? So in the near term, is if let's say the Nasdaq unable to hold above the 25,000 point, then we could see a risk of a pullbacks over here. Means that the selling pressure could increase over here, right? So this will lead to a short-term period of a downtrend. right? So these some things we want to see if this could happen, right? So right now this is a channel that we could plot. Okay, if you're looking for the peaks for channel, yeah, this will be some of it as well. Okay, so yeah, next same. Okay, so we should be cautious of any bearish reversal, okay? Especially we are on the March uh, minus. Okay, so this is something we want to be cautious on. Okay, and next one. Oh, sorry. The Dow Jones. Yeah, Dow Jones. Yes, yes, yeah. Dow Jones. Yes. Okay, so there's a short, what we call this is head and shoulder. Okay, so this is a head. This could be a shoulder. Okay, shoulder parts. So right now this is the net line, and we are seeing another resistance over the shoulder line. So if the breakout happens on the neck line over here, and yes, then we would have the bearish confirmations, right? So this is one of the opportunity we could look at. All right, so this is the US indices, and the next would be the gold. Okay, let's see for gold. Okay, let's see if gold, what's the gold? Right, gold market is actually breaking out the recent patterns. Okay, the recent resistance area, okay, which is over here. Okay, this 5,000 to 5,001, and if you want to look at it for more details, okay, there is actually a ascending triangle as well, right? So the ascending triangle has already broken out. Okay, right now this would be the supports. So technically, as long as the 5,001 to 5,000 support hold, we are still seeing the opportunity of another leg up for the goal, right? So especially if let's say we are seeing a risk aversion or any like a risk off sentiments in the markets in March, then we would still expecting another leg up for the goal, correct? So this is where we want to focus. Upper resistance is on 5,003 to 5,250 or 5,240, somewhere here, right? So this is where we want to watch for the technical level. And the last one would be the oil markets, right? So oil markets on the uptrends for the past month, okay, largely because of driven by the what we call as the risk premium over the US-Iran tensions, okay, which is everyone is afraid that it might escalate into a war, okay, right? So we are seeing the risk premium going up. So right now, both of them are actually having a talk. So I believe if the talk, I mean the outcome of the talk is gonna impact on the oil markets. All right. So if let's say the talk went well, okay, sorry, let's say if the talk went bad, okay, the risk premium might increase again. Okay, it means that there might be a risk into a war. So this would bolster another leg up for the oil price, right? So this would be the upside risk for the oil markets. Okay, and on the other hand, if let's say the fourth round of the talk between the US and Iran, well, the woods uh, evaporates the risk premium over the past month. This says the oil market might go into a reversal. It might go into a reversal. Right? So this is why we want to be cautious. And for the technical outlooks, I would focus on the 65 dollars area over here. Okay, and the upper resistance of 67. So basically, if you look at the chart patterns, okay, this would be the consolidation area, and this is a breakout and consolidate again. So there's two different zones over here, right? So right now, this is the major resistance zone. If we are seeing any fear to break out on this area, and a breakout over here would signal a bearish pullback, okay, or a corrective move. So it means that if the $65 range or the supports are able to hold, we might see a pullback over here in near terms, especially if the talk between the US and Iran went well. Okay, this would erase the risk premium in the oil. Okay, and provide catalyst in the pullbacks on the oil price. Right, so this would be the March focus for the oil market. And the same thing goes to the UK oil as well. Okay, the Brent crude oil as well. So the support is on 70 to 70.7, right? Resistance is on 72.5. So the breakout over here would suggest that there is a deeper corrections to this area, right? Or at least to 67 or something, right? So this will be the range that we're going to focus if this level breakout, right? So if you're asking for my opinions or my view, okay, I believe the trade talk and it's not a trade talk, sorry, the peace talk or the negotiation between the US and Iran is likely to went well, okay, according to what we have right now, okay, it's likely to went well, okay. So if this really happens, then I believe the oil markets could potentially go into a pullbacks, a wave of pullbacks, right? So this is based on my personal view, right? So for whether it's going to be a pullbacks, I believe we should still wait for the technical breakout, okay, or a more certain news came out, right? So this is where we want to look at. So basically, this is those that we want, these are the big four assets that we want to focus on the March markets. All right. So these are all these things. So basically, these are the ones. So do you guys still have any questions? Sorry, having a bad flu over here, so it's very difficult for me to talk. All right. So if there's no questions, then I guess we're gonna end our live webinar for today. So if you still have any questions or anything you'd like to ask, just leave your message on the chat area. So I'm gonna answer to it. So if there is no, we're gonna end this webinar in 1 minute's time. All right. So thank you guys and have a happy weekend.